Welcome back. I am so incredibly excited to guide you through today's explainer. We're bringing some vibrant, fast-paced, anime-style comic energy to our visuals today, and honestly, we need it because we are unpacking an absolute monster of an event, the June 10th, 2026 cryptocurrency market crash. The market is literally flushing red. Headlines are screaming, and there's this massive tug of war happening behind the scenes. So our goal right now, slice straight through the panic and separate the short-term noise from the actual long-term signal. Let's get into it. Okay, let's dive into this. It's the absolute burning question on everyone's mind today. Why on earth is the crypto market crashing right now? Look, when you wake up and see a sea of red across your portfolio, human nature kind of screams at you to panic, right? But as we know, to really understand what's going on, we've got to look at the hard data driving the momentum. Right out of the gate, Bitcoin has taken this sudden, sharp nosedive down to the $61,000 level. It's continuing a pretty harsh downtrend from its May peak of over $82,000. I mean, we are talking about a massive $80 billion, yes, with a B, completely wiped from the total crypto market cap in a mere 24 hours. The sell-off has been incredibly swift, and it's basically pulling down major altcoins right along with it. And honestly, sentiment has absolutely collapsed right alongside those prices. The crypto fear and greed index just plummeted to a 9. That is straight up extreme fear territory, folks. It's a massive drop from a relatively neutral 48 just last month. Now, this index completely validates the immediate panic that retail investors are feeling right this very second. But remember, extreme fear, it's usually just a symptom, not the root cause. So here is our roadmap for today. First, we'll look at the June market crash. Second, macro anxiety and liquidity. Third, the spot ETF bleed. Fourth, hacks and political profits. And finally, regulatory clarity and adoption. All right, section 1, the June market crash, bleeding markets and low liquidity. Now, a lot of analysts are calling the current environment a necessary cleansing phase to sort of reset market positioning. But man, this particular flush is hitting incredibly hard, and that's mainly because of severely low liquidity. Think about this. Just 48 hours ago, daily trading volume was sitting at over $200 billion. Today, it's plummeted to just $85 billion. This creates what traders call thin bids. When you've got fewer buyers and way less depth in the order books to absorb the sales, any fresh selling pressure is drastically amplified. It's like throwing a boulder into a puddle instead of an ocean. Moving to section 2, macro anxiety and liquidity, the root causes. So we're essentially looking at a perfect storm of macro squeeze triggers here. Investors are seriously bracing for the U.S. Consumer Price Index report, with expectations that inflation could hit a 3-year high of 4.2%. On top of that, Treasury yields are remaining stubbornly high, and if that wasn't enough to chew on, we're seeing a massive liquidity drain. Capital is actively rotating out of crypto and pouring into the highly anticipated SpaceX IPO happening later this week, an IPO that is currently 4 times oversubscribed, by the way. Those Treasury yields are a massive piece of this puzzle. With yields hovering securely near 4.45% to 4.52%, regulated capital is actively de-risking. You see, the math for institutional investors just completely changes when traditional risk-free assets are yielding high returns. Capital naturally flees volatile, non-yielding assets like Bitcoin in favor of that guaranteed stability during uncertain macroeconomic times. It's just business. All right, section 3, the spot ETF bleed, analyzing the institutional exodus. For the last year, institutional adoption through ETFs has been the primary narrative driving prices upward. We all know that. But today, the marginal buyer has abruptly flipped to become the marginal seller. U.S. spot Bitcoin ETFs just recorded an unprecedented 3.4 billion weekly exodus. Literally the largest weekly withdrawal event ever recorded for these products. This directly forces the selling of underlying Bitcoin just to meet those redemptions. But hold on, the data suggests this behavior actually leans heavily toward cyclical profit-taking rather than some panicked structural exit. Look at it this way. A lot of institutional buyers entered the market earlier when Bitcoin was much, much lower. With the macro environment shifting and that scary inflation data looming, it's honestly an entirely logical move for portfolio managers to lock in their massive gains. To really understand the scale of this rotation, consider this. BlackRock's IBIT fund alone saw nearly $1 billion in withdrawals during this exact same period. When the market's most dominant popular institutional vehicles experience bleeding of that magnitude, it sets a definitively risk-off tone for the entire rest of the market.
Ultimately, this ETF exodus represents a broader, very real theme of regulated capital de-risking. It's a calculated institutional shift away from volatility and straight towards safety, while the broader economic picture remains foggy. It's definitely a painful cyclical reality for us looking at the charts, but it's a completely normal function of traditional market participants managing their exposure.
Which brings us to Section 4, Hacks and Political Profits. Ecosystem shockwaves. Beyond the macroeconomic pressures, we've got specific events sending immediate shockwaves through the ecosystem. Case in point, the Humanity Protocol recently suffered a dramatic $36 million hack due to stolen private keys. This triggered an immediate, brutal 80% crash in the token's value. And while we are seeing a minor 34% recovery attempt today, events exactly like this heavily impact short-term retail sentiment and directly fuel that extreme fear gripping the market right now. We're also seeing politics intersect with digital assets in a huge way. A recent Reuters investigation found that crypto ventures linked to the Trump family have generated at least $2.3 billion in profit. Regardless of your politics, we're just looking at the facts here. This adds a whole other layer of complexity to the broader market narrative as high-profile political figures continue to heavily interact with the space. Let's look at Section 5, Regulatory Clarity and Adoption, the signal. Now, beneath all these cyclical price crashes, the structural maturation of the industry is actually highly visible if you know where to look. There has been a staggering 589% surge in tokenized real-world assets. That's huge. Furthermore, traditional finance integration is marching forward globally. For instance, Japan's SBI Shinsei Bank is actively introducing crypto vouchers to reward their regular depositors. So, despite the current volatility, the underlying infrastructure is quietly but surely continuing to mature. So, the million-dollar question, where is the bottom? Well, analysts are noting that the market is unlikely to find a durable floor until that U.S. inflation data is fully digested and those record-breaking ETF outflows actually begin to stabilize. And the stakes are high right now. If the CPI data reads hotter than the anticipated 4.2%, Bitcoin genuinely risks losing its critical $60,000 support level. If that breaks, it could potentially send prices tumbling down to $55,000. So, we are smack in the middle of a brutal, liquidity-starved macro squeeze, but the underlying plumbing of the market, from that massive surge in tokenized assets to traditional bank integration in Japan, it's all continuing to grow. So I'll leave you with this. Once this inflation data is firmly in the rearview mirror and the institutional selling finally exhausts itself, how high will the signal rise above all this noise? Keep your eyes on the data, stay sharp, and I'll see you in the next explainer.